Peter Rose, Longwood Currency Trading. It's mid-May and 2021. You'd never know it by the way I'm all bundled up. It's turned cold all of a sudden, and I have walk the bow dog duty this afternoon. So I thought I would do that because the clouds are coming over. They're very pretty, as you can see, but the wind is blowing, and as you can see up in the trees, it's blowing in some very inclement looking clouds, and we've already had some sprinkles of rain. So I don't want to get wet because it's cold, and so I thought I'd bring the bow dog out for his walk now through the woods. Hey Bo, come on, we're going this way. Come on, go, go, go. All right. It smells so nice and fresh out here. So, how do you beat the institutional traders? How do you beat the market, the Forex market? You don't. Why would you play that game? What are you going to do? You go to the swimming pool, and there's a bunch of Olympic swimmers competing, and you're going to ask me how you beat one of those Olympic swimmers? How you get in that pool and compete with them? What are you, fucking nuts? You can't. And you have to remember that you're trading for a different purpose than the institutional traders. They're not trading your game, so their rules are totally different. You think your rules are hard to figure out? Try to figure out what some trader's trying to do, trying to get the best price for his client for their $6 billion worth of orders. That's what he's got to do. What the fuck do you have to do? Are you competing to get a piece of that $6 billion? Do you have a $2 or $3 million account? You don't. You had a $3,000 account or a $30,000 account or whatever it is as a retail trader. And, you know, as a $30,000 account, you can make a significant enough amount of money that it could help your lifestyle. You're not going to make $100,000 a year from a $30,000 account, but geez, if you could do $20,000 a year, excuse me, 20% on that, $6,000 a year. Let's say you're making $40,000 a year and you're going to make an extra $6,000. Let's say you're making $60,000 a year and you're going to make an extra $6,000 on that $30,000. That's 10% of your salary. You make 10% of your salary, and you're trying to compete with institutional traders that are pushing $6 billion around in this $6.6 trillion a day market. You're going to try to compete with them? It's not going to happen. And the Bo dog doesn't want to come. Hey, Bo, come on. Ah, man, every time I come out here, I'm doing a video, I got to keep calling the Bo dog. You know why? Because he's not my dog. He's my wife's dog. My wife feeds him and pampers him. I was cooking for the Bo dog last night, little pieces of chicken, stir-fried little pieces of chicken, so that some bitch could have something nice to eat with his dog food. Just because we were having a really nice marinated chicken for dinner didn't mean that I had to fix some of that chicken up for him. But Sue says, nah, you can fix the Bo dog some food here. So he knows where his bread's buttered at, and so because she's gone, he wants to sit in the yard or on the stairs or wherever it is looking out the window when she comes home. He doesn't care about me. I'm waiting for her to come home. So I can't compete with her for his attention because I don't feed him. I'm not up at 5:30 in the morning, so that he gets fed at 5:30. I'm not getting up at 5:30 to feed the dog. So I can't compete. Why would I want to try? So it's the same thing. What's the secret of beating the market? You don't. You can't compete with those guys. If you think that you're going to get 50 pips a day out of the market, you're out of your fucking mind. I have become inordinately adamant recently about my feeling that long-term Forex traders don't exist. Show me some. Now, you can be a long-term stock trader, probably do okay. You can be a short-term stock speculator as well, and probably do okay. But I don't think you can be a long-term currency trader. And the reason for that is because of the leverage that we're working on and the amount of movement these prices can have can really jack your ass if you're out there hanging in for a long term. I just did a video a week or so ago on a situation where it was a Sunday, May 9th, at 1700 hours U.S. Eastern Time. There was 137 pip 1 minute pin bar. 1 minute pin bar. That means the price went up 137 pips and came down about 130 pips in 1 minute. Now, if you were a short-term trader and that hit your short stop, you'd be fine. But if you're a long-term trader and your stop is way under that or above it or whatever, doesn't matter. You're gonna absorb that loss, and then you're gonna come to your desk in the morning, and there's a 137 pip loss. You know what 137 pip loss means? It's $1,300 on a one lot. So if you got a 10 lot, 10 times $1,300, $13,000, poof, gone. And how many times do we see the price action in the currency market do stuff like that? I mean, it's not that the institutions are hunting you or saying, oh, look, we're looking at level 2 stops and we see all these guys, we're going to go out and grab this liquidity. You know, the retail traders don't have any liquidity. I mean, we participate in the liquidity. The dumbasses contribute to that, but we don't. We're only 15% of the market from a dollar value. They're not looking at us and going, oh, we're going to go up and grab these 5 fucking traders that are out there with their $3,000 banks. They're not going to do that. They're trading for a whole different reason. So why are you studying all this shit that these bank traders are trying to teach you how to trade the Forex market? Because they're not trading that way. The bank traders don't trade that way. Do you know how the institutional traders work? There's a whole group of traders and all they do is they're on the buy side. And all they do is buy currency. They try to get the best price for it. They may not have a client order, but they're just in there buying. They're accumulating inventory. And on the other part of the bank, there's guys that are selling it and getting rid of it. And when one of the traders comes in and says, geez, I need to unload $3 billion worth of X currency in favor of this currency, somebody's got it in-house. They make the transaction and you get this big move. Once they're done, price comes back. That's what the pin bar is all about. You flush the toilet, the water flushes out, and water comes back. Man, so you think you're going to compete with that? How do you beat the market? You don't trade like the big boys. Be happy with taking 5 pips a day. That's $5 a thousand, $50 on a one lot, on a full lot. $500 a day on a $100,000 account. 5 pips. 5 on 5 pips. How tough is it to get 5 pips? No, you want to get in there and you want to swing for the fence. You want to try to get 30 or 40 pips. I'd like to get my dog to follow me. Bo, come on. Oh, I get tired of calling a dog, but I can't compete in this market. There he comes. He's not burning his ass up to come with, hey, hey, come on, come on. He's not happy about coming out here. Look at him. He didn't give a shit about me. He's not playing my game. So how do you make money? But you just don't compete with the big traders for 50 pips a day. You're trading with a $3,000 account or a $10,000 account. You're not in the same ballpark. You're not trading for the same reason. You're not trying to fulfill a client order. You're trying to make $100 a day. That's not tough to do as long as you can get the money part of it out of your head, that you're going to double your account in 6 months. Can you double your account in 6 months? Yeah, if you get 5 or 10 years experience and you really know what you're doing, you can do that. And listen, don't listen to these assholes that are trading at 200 to 1 leverage. Not allowed in the United States, in Canada, and Britain. Not allowed. You want 200 to 1 leverage, you go to fucking Turkey or Cyprus or something like that. That's just the kiss of death. If you're playing in the U.S. stock market, best leverage you're going to get is 50%. You want to buy commercial real estate, best deal you're going to get is 30% down. Residential property, if you're a first-time buyer, 3.5% down, 3.5% expenses from the federal government. If you're just a normal Joe blown out and it's a good market, you can probably get 5%, 8% down loans. Otherwise, you're looking at least 10%. And maybe if things are really bad, you may be looking at 20% to buy a house. You want to buy a $400,000 house? Guess what? What's 20% of $400,000? It's $80,000. Where can you play in such a liquid market where your chances of success are so good if you don't try to compete with the guys that are running the table? As a software engineer, I've written a lot of simulation code for price action. In fact, I'm working on right now that studies a particular changing of parameters for staging in and then coming out of a situation, because I'm looking at simplifying even further the systems that I have in trading, so that I'm trying to take out the decision process. You get into a trade and you can easily try to convince yourself that each trade is different, but it's not. To the bank trader, he's not even looking at the trade. He's just accumulating inventory. He doesn't give a shit about what the macroeconomics are, or, you know, is the bank going to need $500 million of Turkish lira and the New Zealand dollar. He didn't care. His job is to sit his ass at that table and accumulate money. They're not trading for 10 pips. They're not watching the charts, looking at what some dumb ass retail trader is doing in a 15 minutes time frame. If they're looking for a lot of liquidity, they'll be looking at the 4-hour chart, because that's where if they're going to unload their inventory, they have to make sure that the price action is there and the liquidity is there in order for them to transact their business. Now, they don't care whether it's you or another bank. You're going to get your ass reamed, but the other bank that's on the other side of the trade, because they're not losing, because they're trying to do the opposite. You got a UK investment bank buying pounds and selling dollars. Well, you got a guy on the other side that wants to buy dollars and sell pounds, because he's on the other side of the pond. Maybe he's a US investment banker. And so these two guys, whether they know it or not, they got different clients, Well, one guy's got a $4 billion order and the other guy's got a $6 billion order. And so between them, they're going to swap $2 or $3 billion worth of deals to benefit each other. But they don't even know they're trading. Or sometimes they do. You know, you've seen the movies. The guy picks up the phone. Hey, Bob, I got, 420 million of 10-year bonds. What do you want to do? Like, it's the same thing. But most of it's done electronically. So you think they're really hunting for you? No, they're not hunting for you. Because you don't understand what the big guys are trying to do, you're just in the toilet and you get flushed out. My stockbroker told me back in the 1980s, a rising tide lifts all boats and a falling tide drops all boats. That's pretty common saying. Back in the 1980s, it wasn't. If you happen to be on the boat at the wrong time, that's your fault. It's not the market. It's not the institutional traders. They're just doing their business. So how do you compete? You don't compete with them. Figure out what you want to do. How much money do you need to make on a yearly basis that would make the trading worth your while for the size of the account that you have? What's reasonable? Figure 20%, just as a starting point. Don't try to double your account. And don't get into these markets if all you want to make is 4 or 5% a year. The risk is too high. You better know what you're doing so that you're shooting maybe for a 40 or 50% a year return, but you'd settle for that 20%. So what does it take? I mean, take a bank of $30,000 and 20% of that is $6,000. Would that improve your lifestyle? If $6,000 isn't enough, then you got to have a bigger boat. You got to have more money in your account. How much do you want to make? You want to make $60,000 a year? Well, 20% of some number is $60,000. And then when you finally wake up and realize that it's you trading for you and not trying to compete with the big guys, you'll have a lot of fun. If you get into the pool with all the Olympic swimmers, they're going to make you look stupid. They go, what the fuck are you doing in my pool? Well, don't go in there. Go next door to the family pool and splash around and have a good time. And don't feel bad because you're not competing for an Olympic trophy or something. Because if you were good enough to compete in the Olympics, you wouldn't be watching this video. Come on. Be realistic about what you're doing. You're not going to compete. And if you're trading currencies long term, I think you're a fool. There's certain times when you might want to be you might see that you're at a swing point and trading between channels that are, I don't know, 500 pips apart or something like that, and you figure that in the long term you might get 300 or 400 pips if you held for several weeks or something like that. I mean, you could get some of these pairs have 100 pip a day ATR, and you could do it in 3 days, 4 days. You could, but your stops also could take you out at 150 pips or 200 pips or whatever you set that stop at. If you don't know what you're doing and you add up all the dollar losses there, you're not going to be able to survive very long. But if you could just nick away at it, you get a $10,000 account, you lose $800 when you're wrong, and you make well, it'd be 80 pips, sorry. Well, you lose $80, not 800. You lose $80 when you're wrong, and you make I don't know, $1,000 or 150 or $200 when you're right. So you walk away with $40 over 2 trades. You make those in a day. You make $40 a day. Trade 4 days a week. It's $160 a week. $700, $800 a month. I mean, you're not going to feel good about that if you're trying to ride some friggin' trend that some Forex educator is telling you should be doing. Oh, you know, you're going to shoot for this 100 pip target, and you're going to at the 25 pip point, you're going to peel off some. It never hurts to ring the cash register, but you got to take a 50 or an 80 pip risk. That's just ludicrous, because you, as a retail trader, even with a year or 2 years of you don't have enough experience to be able to understand trade entry well enough so that your win-to-loss ratio is going to be strong enough to overcome the not only the VIG, the spread that you've got on the currency pair, but also just on your win-loss ratio. But if you bring that all down and if you forget about competing at a professional level, and you say, look, I'm going to try to make 10 pips a day. I got a $10,000 account, and I want to make 10 pips a day. So if you get a $10,000 account, each pip is worth $10. You make 10 pips, you make $100. $100 a day. You do that 3 days a week. It's $300. Man, I'd rather do that and just do $300 a week. And maybe I'll lose if all goes to shit. Maybe I lose $300 for the week. Well, that's a lot better than losing $3,000 in the hopes of making $6,000. You know, it's just it's an economic scale that you have to accustom yourself to, because if you don't, you're going to find yourself in the pool with Olympic swimmers, and they are going to eat your lunch. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.